Thank you so much, Greg, for joining us here at the Dwellynn Show. I really, really appreciate your time. And I know you've been super busy, so just carving out this time for us, I really appreciate it.
Well, thank you very much for having me.
So I think you do a way better job than I can. Can you just, tell us a little bit more about yourself and, kind of what you've been up to lately?
Sure. Well, I'm a certified public CPA. I'm also a certified tax coach. I'm a business owner. I'm a former New York City police lieutenant. I spent about 17 years in the police department. As a certified tax coach, I belong to a select group of tax practitioners throughout the country, and we focus on tax planning for our clients, and basically what legal ways that they could keep more of what they make, reduce their tax liability to the federal government. So I go to an awful lot of continuing education. I run a mastermind group for people that do what I do. And, it's all about keeping more of what you make, versus, just putting the right numbers in the right boxes.
So there's a lot of talk about tax planning and, just taxes, and real estate investors are kind of notoriously known for not wanting to pay a lot of taxes. I don't know if that's true or not, but that's kind of the idea. So what would you say are kind of like proactive tax planning ways, and, how can we kind of, minimize that taxes? I think it's not like we don't want to pay, but just not pay more than we need to.
Correct. Well, the first thing is to do some planning. Don't expect to go to whoever you're dealing with in February, March, or April and get some planning done, because by that point, it's typically too late. All right. So being proactive throughout the year, communicating with your CPA, seeing, what you can do a little bit differently that'll reduce your tax liability. So planning is typically the biggest mistake that we see people making. Nobody's planning. They kind of put their head down and they don't want to deal with taxes. Where if they spend some time, they'd probably save some money.
All right. So, yeah, I mean, you brought something very interesting up. I mean, real estate, entrepreneurs or investors like myself, it's almost like you forget, time goes so quickly, and then it's like March or April, you're like, oh my God, I need a CPA. I'm dead. People are running around, just waiting to hit that deadline, right?
Yes.
I mean, in your experience, right, what would you say is kind of like the biggest mistakes that you've seen, investors or even business owners kind of make?
Well, I mean, the biggest mistake we see in the real estate field is, not doing a 1031 exchange if you can do a 1031 exchange, or maybe not doing a cost segregation study to see if you could accelerate the depreciation on that building and take more depreciation expense up front versus having it spread out over 27 or 39 years. So every dollar you get to keep today is worth a lot more down the road. So if I could take $50,000 more depreciation in year one versus have that $50,000 spread out over 27 years, I'd rather take it in year one, put that money in my pocket and either reinvest it or do something with it.
So for some of our dual listeners who are not so familiar with the 1031 or even the cost seg, can you just talk a little bit more about those?
Sure. A 1031 is when you're in real estate, you have a piece of rental property, investment property, and you're going to sell it. And at the same time, you're also going to buy something different, another piece of rental property. So rather than pay tax on it, if you follow the guidelines and use an qualified intermediary, you actually never receive the cash. It sits with the intermediary. And as long as you basically identify a property within 45 days and close on that property in 6 months, that sale is tax-free. Everything just rolls into the next property. So depending on how much tax you might, have, it could make a really good investment decision for you to defer that tax down the road.
Okay. And the cost segregation?
Cost segregation is when you have a study done, and typically, somebody buys a building, let's call residential real estate, and they put it on the books and their accountant depreciates the whole property by 27 and a half years. When you do a cost segregation study, you break that property into 5-year property, 7-year, 15, 27 and a half. So typically you accelerate the upfront depreciation. Certain things you depreciate quicker because their useful life is shorter. So you get more of a deduction up front. So obviously if you have real estate that's making you money it makes sense to do something like that.
Gotcha. Thank you so much for that. I mean, there's something else I really do want to touch on is as real estate entrepreneurs and investors, you always figure out, well, I don't want to wait till April 15th to get strategies or tips or, from my CPA, right? I want to know today, how can I really, really, optimize my tax strategies to better grow, to help me grow my business. So what would you say, what's the best way to really leverage having a CPA? Because sometimes it feels like to real estate investors that you have your CPA, they do your taxes, but you don't really talk to them until, when you have your yearly review.
Right. Right. So you need to communicate with them on a regular basis. So, and with real estate, it might be every month. It definitely should be before if you're buying and selling properties, before you go to sell properties, you want to look at and have that conversation. So everybody's situation is a little different. Typical business owner, I would say at least once a month, depending on how much real estate you have and what you have going on. Maybe not once a month, why not at least once a quarter? But if you have a transaction coming up, have that conversation, so go from having that CPA that's, what I call over depreciated Frank. All right. The guy that's just putting the right numbers in the right boxes to somebody that's being proactive and is going to come to you with ideas where you could save money. Okay. So those strategies could be, hiring your kids, how to make that tax free. All right. It could be a medical expense reimbursement plan, whether it's paying for your kids' dental work or their braces, or maybe if you're a little bit older and people are getting dental implants. There are ways and strategies where you can make those things tax deductible while you get a tax deduction for them. If you go over a certain threshold, most people don't meet that threshold normally. But if we set up a medical expense reimbursement plan, we could get a dollar for dollar deduction on that.
Oh, wow. That is fascinating, especially that you mentioned, employing your kids, right? And I think I've heard this before on another podcast where you can employ your kids to work in your business, even if they're helping you seal envelopes and, they're not as old as, they're not ready to get into the job market. Can you just talk a little bit more about how that works?
Sure. So the tax court has ruled you could hire your kids as young as 7. I like to tell, our clients, wait till they're about 11 because you have to pay them a reasonable compensation. So you can't pay them $50 an hour to lick stamps. And then with the new tax laws, on a federal level, a child can now make up to $12,000 a year in earned income and pay no tax on it. So if you have 2 kids and let's just say they're teenagers and they do work for you on the weekends and they're getting $12,000 a year from you, that's $24,000 that you basically turn into tax-free income. So if you're in the, let's just say 25% bracket, you just save $6,000, $7,000.
Wow.
Yeah. So, and that just takes some planning, and obviously you have to document everything you do. We make sure our clients have, a schedule, they sign in, they sign out, they keep track of it. Kids actually get paid on a regular basis, just like anybody else would. And there are times you could set it up the right way where they're not even responsible for paying any Social Security and Medicare tax. So that's a super, super win.
Wow. Yeah, that's amazing. That's really amazing. Before we get to your book, though, a really fascinating book. I still want to ask a few other questions.
Sure.
What are kind of like the main mistakes that one could make that could really cost us? I mean, you've mentioned a few amazing strategies, but what are the things that we can do?
Mistakes are failing the plan, audit paranoia. I'm going to be audited if I do that. Well, if the government says you can do it, and you do it correctly and you document it, then do it. Don't be scared that they're going to audit you, because if they audit you and you have the documentation to back it up, you should have no problems. But if you don't document it and you just take a deduction for something, you're going to have a problem. So operating out of the wrong business entity, do you have a management company? Do you have that set up the correct way? Are your various pieces of real estate, are they held correctly? Are they held in your personal name? Are they held inside of corporations? Are they held inside of LLCs? How are you holding those? Are you using a home office? Are you deducting a home office? When you have a home office, it opens up travel from one office to another, where normally wouldn't be deductible. It also opens up the home athletic facility, which could be your home gym or your home pool. Now that becomes deductible. So there's a lot of strategies you can use that's going to, really help you keep more of what you make. So you're going from just somebody putting the right numbers in the right boxes to somebody that's helping you be proactive and keep more of that money.
Fantastic. Okay, so next thing, I want to talk about your book, right? Secrets of a Tax-Free Life. I want to live a tax-free life. Can you talk a little bit more about kind of your book and give us a few highlights from the book?
So the first book I wrote was Secrets of a Tax-Free Life. I co-authored that with about 11 other people. That was an Amazon bestseller. And my chapter was really dealt with hiring your kids, how to make your child's cleats tax deductible. My most recent book is the 10 biggest tax mistakes that cost business owners thousands. And that pertains to real estate investors because they own and operate a business. And those are some of the strategies we talked about. And, if you go out there and you communicate with your CPA, he should be able to come up with some strategies that's going to help you save money. So do you want to overpay your taxes, or do you want to keep more of them? Do you want to go out and buy shoes? Do you want to put more money away? Do you want to use that money to buy additional rental properties, or do you want to give it to Uncle Sam?
Right. I think we all know the answer to those questions.
Exactly.
So we're definitely dwelling into the quick round. So these are going to be quick questions, quick answers. You ready?
Yes.
First question: what separates you from, the next guy or the next girl? What's that differentiating factor?
The thing that is my ability to communicate, and the fact that we're proactive, and everything we look at, we're looking at from the point of view is, what can we do a little bit differently that's going to save us taxes? We're not looking at just putting the right numbers in the right boxes and then ending there. We start with looking at things proactively.
It's like that difference between a bookkeeper and an actual CPA, right? I like that.
Right, and it goes a step further because there are a lot of very good bookkeepers out there, but they're keeping your books. We're being proactive. We're looking for strategies for you to keep more of your money.
I love it. Next question: what was the last book that you read, and what was the one thing that you got from the book? Obviously, it can't be your own book.
Okay, well, I'm actually reading a very good book right now, Never Lose a Customer by Joey Coleman. And it's just all about, the customer experience, and, you need to, too often people, they get the client and then they forget to do the things that they need to do to keep that client happy and, not have that client feel that buyer's remorse. So it's actually a very good book, and I'm about halfway through it.
Nice. I haven't heard of that one. That's a good one. Last question. So you've got your books, obviously you've got your CPA practice, you've got obviously family. What do you do for fun?
Oh, what do I do for fun? Well, I belong to a boat club, and we get to go out on the Long Island Sound, and we could actually take the boat over by Manhattan and drive around by the Statue of Liberty if we want. Just go out and relax and spend time with the family, do some traveling. My kids are a little bit older now, so I'm able to do that.
Nice. So if one of our Dwell listeners is listening to our conversation and they think, oh wow, I really like what you're doing, and I really want to connect with you, what is the best way to connect with you, and how can our viewers just get to learn more about what you offer?
Sure. So our phone number is 516-869-4051. We're also going to give you a link, a few show notes to a website, and give your listeners the chance to actually receive a paper copy of our book. And that website is going to be craigcodyandcompany.com/Dwellynn. And if they go there, they could opt in, put in their name and address, and we'll send them out a copy of the book.
Thank you so much for doing that. I really, really appreciate it. Thank you so much. So, this is towards the end of our conversation. Any last thoughts to our members out there? Yeah,
don't wait until February, March, or April to talk to your CPA, because he's going to have his head down. He's not going to have the time to do what needs to be done now. This is the time when you need to start planning for 2018. It's already towards the end of the year. So you want to do what you can and keep more of what you make, or just give it all to Uncle Sam.
Thank you so much, Craig. I really, really appreciate it. I'm sure we'll probably catch another episode probably sometime in the future. Thank you so much.
Thank you very much for having me. Have a good day.